All right, we got about 3 minutes until we get things going. It's been about 3 weeks off for us, so it's been a minute since we've done this. Hope I can remember how this works. Fridge opener, kicking things off in the chat. What's going on? And I made a slight modification so that chat messages now stay up in the window instead of disappearing, so we could at least kind of stick with the conversation in case there's some sort of message in the chat that I'm responding to. But yeah, small improvement right there. 2.5 minutes until we get things going for tonight. There we go. We got Orbital Raptor in the YouTube chat checking in. What's going on? And I guess that's the other feature too, because people in the Twitch chat can't see the people in the YouTube chat. So if it all goes up on the TV, you guys can see it. So there we go. Another benefit. We've got 1:45 till we get things kicked off. All right, 30 seconds until we get things going as a few more people pile in on the stream. We're still gonna do the giveaway if we get to 30 viewers. However, I've admittedly have not been terribly active on social media and promoting our group, so I think 30 viewers might be a goal for a future stream. But rest assured, it's coming back soon. We'll get some more people in and get some more content out. 5 seconds until we get going, and we might as well just X out of it right now. There we go. So with that out of the way, welcome back to another weekly live stock market stream. I guess calling it weekly at this point is maybe a little bit misleading because we've had 2 weeks off. I think the last one we had was on May 30th, and a lot of the times when you see traders, go dark for a little bit of time, you assume the worst. But since May 30th, we've kind of been hanging in there. Now the S&P 500 has taken a very, very big dive over that weekly period. Over the end of May, June, up to this point in time as of today, June 20th. However, over that time frame, and I'm not going to count this because this is our projected profit for this week, but over that time frame, we've lost $4,000. And if we zero this out really quickly to illustrate the example of where we're currently sitting, we're down 2.81% so far in June, as opposed to an 11.90% drop in the overall market, which we measure via the S&P 500. Now, if we want to compare ourselves to the NASDAQ, it's even worse for the NASDAQ. So super happy with where we're sitting so far in June. It's one of those situations where, we always talk about our overall goal in the market being to outperform the S&P 500, to outperform the NASDAQ. And what we've done so far in June is a huge head start in that regard. So again, a 2.81% loss. And again, it sucks to lose money. We all want to make money. That's why we're here. But we have to understand what's realistic in the market. And when the S&P 500 is down 11.9% in 3 weeks, and again, the average yearly return in the S&P 500 is 9 to 10%. So I guess for a little bit of perspective, we could say that it lost an average yearly return over a 3-week period, which is nuts. But we've hung in there. We've only dropped 2.81%. And as we've illustrated with the trades that we have set up for next week, we have a 4,232 base profit. So if we just stay flat for the next 4 days in the market, we're going to be profitable in June despite a double-digit percentage loss. And for the first time all year, we are outperforming the S&P 500. We had pulled even with NASDAQ and started to outperform NASDAQ by a little bit greater of a margin over the last few weeks. But we have finally eclipsed the S&P 500. We did dig ourselves an enormous hole in January, which was due to some poor position sizing, but we've taken our hits, we've learned our lessons, and applied those lessons going forward. And I'm super, super excited about where we currently stand and where we are moving forward. Just to illustrate further our performance against the S&P 500 before we jump into last week's recap, this is what it looks like. We started off with an enormous gap. We were down 14% before the end of January, which is insane. But if we go to our yearly performance, after the first 3 weeks of the year, what's crazy, even if we exclude this week right here because it hasn't happened yet, we're green. And even though we're only green about $1,300, if we highlight this row right here, we're profitable over a period where the S&P 500 has dropped from 437 down to 365. And that's good enough for about a 15% drop in the market. So if we could make money over a 5-month period in the market where it drops 15%, we are going to be looking very, very good. Not just for the rest of the year, but any sort of volatility that we see from the market going forward. So while we are losing money on the year, the biggest thing we could point to is that big January where we admittedly made some mistakes with position sizing, but we've adjusted. We're moving forward with a smarter, more efficient strategy. And the best way to say, how can we, can we still rely on this strategy going forward is to point to exactly what we point to, where after the first 3 weeks of the year, we've been profitable despite an enormous drop in the S&P 500. So we're going to keep doing exactly what we're doing. Even though we're temporarily losing money after the first 3 weeks of June, down 4K, I'm very, very confident we are going to get it back better than ever, and we are going to be looking good headed into the back half of 2022. So let's talk about what we did last week, what we did well, what we did poorly, and what we ended up at. So as to not bury the lead here, we lost about $2,000, which is a 1.4% loss. But of course, the headline that we really want to pay attention to is the fact that we lost 1.4% on a week when the market dropped 6.15%, outperforming the S&P 500 by 4.76%. So we are accomplishing our goal, right? And if you look at the last week, we outperformed by 4.76%. Week before that, even though we lost money, we outperformed by 3.6%. Week before that, we only made $8, but another outperformance by 1.16. The week before, we outperformed by 1.85. The week before that, 5.07. But you kind of get where this is trending. Over the last 5 weeks, we've outperformed the S&P 500 by an average of 3.29%. So, all that to say is what we're doing is working against the market. One of the biggest issues we had off the bat, and we could really go back and look at those terrible weeks, was when we started with 15 roadblocks and eventually 15 affirmed positions on top of that, and those just got crushed and led to some of the weeks where we blew up the third week and lost about 23K. But it happens. It was poor planning on our part. We got a little bit greedy after a really, really good 2021. And speaking of 2021, we're still riding high overall since we've started publicly tracking our trades. We have a really, really big lead on NASDAQ and the S&P 500. But of course, we like to look at it from a 2022 perspective because that's where our big initial drop occurred. And I think we can recover to not only continue to outperform the S&P 500 and NASDAQ, but to get back to a profitable 2022 despite the crazy volatility in the market. But to avoid droning on and on about how we've done recently and overall, let's get into the recap. So what we did well was we let our long-term cash secured puts expire for a little bit of a profit. We actually closed them pretty early because one of those things where it seemed like deja vu, where we were having a good week and it just only takes one really, really bad Thursday or Friday to take all the profit that we have and just throw it down the drain. So we closed out Snow 110 strike puts for 20 cents. We also closed out the Netflix 170 strike puts for 181. That resulted in an additional $270. And I think combined between those trades, we pulled about $500 over the life of the trade. And you might say, HT, you sold these things like 2 months ago. You made $500 on them. Is that really that great? And to that, I would say between those two trades, we had about $4,000 of collateral in play, meaning that our actual return on capital over a 2-month period was roughly 15 to 17%. And if you look at these stocks that we did this on, if we bring up Netflix right here, if it'll load for me, come on, you'll see that in the time frame of our trade, we saw highs of 207, we saw lows of 164, we saw a lot of overall volatility and downward pressure in the market. Yet despite that, it settled safely above our strike and we were able to make money. The same thing with Snowflake, right? If we pull that chart up, you're going to see highs in the 152, it looks like 140 a few weeks ago. You're going to see lows at 110, and we sold that strike right at 110. It bounced off that price level that we identified, and we made money despite what was roughly a 20 or 30% drop in both of these respective stocks. So while you might say, okay, that's not a lot of, it's not a ton of money, we've seen what the market has done over the past 2 months. We've seen what these two stocks have done, yet we still made money, and that is why we like the long-term cash secured put, because typically we don't have to hold them until expiry. We really only have to keep holding them if the stock continues to progress downward. And the next time we do have a red day in the market, I've got my eye on potentially some August expiry, something like that, where we could get away with maybe selling an 80 strike, to where if we only sold one of these, we'd pull $240 of profit. But again, it's something that we would do off of $800 of collateral, meaning that's a 25% return on capital, just provided that Snowflake stays above 80, which is all the way down here. So not only does it set us up to potentially take profit if it rebounds, we also would hypothetically be in a good situation to handle a further drop in the market. And that's kind of the idea we want to continue forward with. I think from a macro perspective in the market, the Fed's made it pretty clear, going from a 0.5 to a 0.75 basis point, or I guess a 75 basis point rate hike, I should say, which was a little bit above expectations a few weeks ago. The inflation numbers are getting out of control. They're unwinding the balance sheet. Until the Fed changes their tune on how they're approaching the market, I think we need to remain cautious moving forward from here to prevent ourselves from having another big down week, right? We've weathered the storm really, really well over the last couple months. And we want to make sure we don't put ourselves in a position to get crushed the way we did in January and the way we did in April. And so far, that plan that we've put into play has gone really, really well. And again, moving back to our recap of last week, the biggest part of this plan, and the part of it that's given us the most benefit, I feel, is scaling into positions. And I think this is so important, at least important enough to the point that I kind of want to make a separate video on it, because it's been going really, really well off of the bat. And we can use Affirm here because it's a great example of what scaling into a position can do for us. And, Roblox as well, because we've really been using it on Affirm and Roblox over the last few weeks. But let's talk about Affirm, right? Going into the week, we would consider a full position size to be 15 contracts. So off the bat, we only sold 5. And we sold a 19 strike put for 80 cents of premium. And you might say, okay, HT, we typically try to go for a 1% ROR. If you look at 80, let me pull up my handy dandy system calculator here to better illustrate this. Okay, you might say, HT, we like to target 1% ROR on a weekly basis, and you would be absolutely correct. So when you look at a 0.8 strike off a 0.8 premium off of a 19 strike where there's 18.2 at risk, your return on risk in this situation is actually 4.3%. So you might say this is a lot higher than what we typically would try to go for. And you'd be, again, absolutely correct. But the idea we're taking here with this approach when we're trying to scale into these trades is that instead of maybe having a full or larger position off of the bat and then just hoping that it stays above the price, maybe target a little bit larger ROR on a smaller position, which would better equip you to protect yourself if the stock did start to fall. Because we've seen a lot of volatility in the market. We've seen a lot of stocks, I think Affirm at one point went from 24 at the beginning of the week to 20 and then finished the week at 30. So we've seen a lot of volatility both up and down. So we want to protect ourselves if we see that downward volatility, because if Affirm spikes back up, we're making $400 off this. We never have to think twice about it, and we take that money to the bank and go have a good weekend. But with this, we know going into the week, our break-even price is 18.2. And if we pull up the Affirm 5-day chart, this is going to do a really good job illustrating what we did every single day along the way. So I think we could maybe start here and say, okay, Monday morning, Affirm is at 19.1, spikes up to 19.62. And I believe, the Friday before it closed at 20. So going into the week, Affirm was at 20. We sold a 19 strike put. We just sit and wait. So if we could tap back to the internet really quickly, or my browser back to Chrome. Again, 19 strike, 80 cents of premium. We know 18.2 is our break-even price going into the week. Fantastic. So let's draw that first break-even price at 18.2. So right off the bat, things are okay. Even though a firm opens red, it spikes up. We're above 18.2. It's all good. There's a candle down. But then at about 10:50, 11 a.m., it breaks below 18.2. So what do? This is when we start to deploy more capital because, look, if it never gets to 18.2 and finishes above this red line, we're not going to lose any money. We're going to make money, and we just don't even need to give it a second thought. So we draw this red line at our break-even price going into the week, and we let it sit. Best case scenario, as we mentioned, is that it never touches this red line. We make money, we have a good week, and we do it again next week. But the reality of the market, the reality of the volatility that we've seen in this market, it dipped down below that. So what do we do when it dips down below that red line? That is when we put part 2 of 3 potential parts into the trade. And we got 32 cents of premium on a 15 strike put. This is about a 2% ROR. And if I had to do this trade over again, I think I would have gone with the higher strike. Because what this does is it increases our position and then decreases our break-even price by about 32 cents. So our break-even price went from about 18.2 down to roughly 17.92. And while, yeah, that's great and all, I think the issue with this is that, the 32 cent reduction in basis isn't, nearly large enough to compensate for what we're doing here. I think individually a 15 strike put offering 2% ROR when the stock's trading at, roughly 18 a share is fantastic. That's why I opened it. Because it was a good individual trade. But as far as managing our current position, if I could do it again, I would start with the higher strike, maybe 17-ish, to chop off maybe 70-ish more cents of premium, which would have gotten us from 18.3 down to, 17.6, and move that red line down here instead for a little bit more downside cushion. But I digress. Here we are. We keep moving throughout the week, and this new red line is our break-even price. So even though it continued to break down through there, putting all 3 parts of your position in on a Monday or Tuesday really, I think, is unwise because, look, if things get better, fantastic. Both the positions you opened are going to have max profit. You don't even need to worry about it. But if things get worse, that is when you're going to wish that you had more money in play to potentially manage the trade. And on Thursday morning, that's exactly what happened. Even though a firm closed on Wednesday afternoon at about 18.65, it gapped down overnight, and then by roughly 11 a.m. Thursday morning was down to 16.5. So that's when I, took a look at those trades and I said, what, if I had to do it again with this 15 strike, I'd go a little bit higher. So that's exactly what I did with the third leg of this trade that we sold, which was a 16.5 strike put for 55 cents of premium. So all in all, we have $1.67 of premium that we're collecting off of an initial 19 strike, meaning our break-even price was about 17.3-ish at that point, which gets you down to about here. And yes, 16.4 is lower than that, but when the stock goes from 20 to 16, aka drops 20% on you in 4 days, sometimes you're going to lose money. But other times, as we have seen often with the theory of reversion to the mean, what goes down must snap back up at least a little bit. And it snapped from 16.4 at the low on Thursday up to roughly, it closed at 18.30 on Friday. So the great part about this was the 2 trades that we entered into, both individually expired for max profit for $435 of profit, and add the, we were able to get out of this for a little bit less than what we sold it for. So $20 of profit here, meaning between these 3 trades, we pulled $455 of profit. And if you'll remember, with the initial 5 contracts we sold at a 19 strike, our max profit was only $400 anyway. So by scaling down, not only did we lower our break-even price 2 times to create a much more manageable trade, we also made more money than we originally were able to had a firm stayed above 19. So even though a firm went down, we made money, and that is the beauty of scaling into a trade. And we could quickly run through the same exercise with Roblox because we did the exact same thing. And with Roblox, you'll notice we got a little bit more money here. We got $890 of profit off Roblox, right? So we started with the 26 strike put. Let me bring up Roblox really quickly on the chart to illustrate this. There you go. We started with the 26 strike put. Let me remove my old drawing. And I think important to note here is that I think it was maybe 27-ish. There was a big gap down Monday morning, so everything on Friday closed a little bit higher, so our cushions were a little bit bigger. But again, with the 26 strike put that we initially sold for 98 cents a premium, we know that our break-even price going into the week is $25.02. So let's go find $25.02. Bingo. So there you have it. This is a little bit different than what we saw from Affirm, because on Affirm we broke through that red line on Monday morning, so we scaled in a little bit further. But with Roblox, even though it was down on Monday, we didn't really need to worry about it because it didn't break through our red line. And even though it was red, we know that if it finished at these levels at expiry, we were going to make money on the trade, so there's no reason to deploy additional capital, and we could just let it ride. And on Tuesday, another big gap down off open, never crossed that red line. It wasn't until Wednesday morning when we saw a big spike down pre-market, but again, market opens, spikes right back up. There's no need to really do anything, and it closed around $29. And then this is when we get back to that volatility that we talk about, going from 29 down to 24 by the end of the day on Thursday. And at some point there, when it broke down below that red line, we caution adding early in the week unless you're super confident. But on a Thursday late in the week with high volatility off a really, really sharp drop, that's when we decided to scale in a little bit further. And this time we did what we said we wished we had done with Affirm. We sold a little bit closer to the money, right? We sold 24.5 strike puts, which was right around here, just slightly out of the money. And it did breach those 24.5 strike puts, don't get me wrong. But we got 84 cents of premium on those, meaning between the two, we got $1.82 of premium off the initial 26 strike. Put our break-even price right here at 24.18, which means our second break-even price was right around here. So we went into the week knowing that if it finished above this red line, we were going to make money. It broke through that red line, but that's okay. That's why we kept additional cash on the sidelines. That's why we scaled into the trade and then lowered our break-even price to here. And again, we mentioned that 15 is what we would consider to be a full position size on Roblox, and we didn't even need to get up to 15. We only got up to 10 contracts last week, and it bounced, both expired worthless. Fantastic for us. And we took home $890 of profit. And again, this all happened on a week when the S&P 500 was down 6.15%. And as you can see, Roblox, it finished above where it started on Monday. But there was a point on Thursday where it was down decently, and same with Affirm. Affirm was lower than it finished on Monday, or lower than it started on Monday, rather. Yet between these two trades, Affirm and Roblox, we took home a profit of $1,345. And these are the types of strategies, scaling in the way that we just illustrated. This is what we're going to have to stick to in these volatile markets, and this is what's helped us outperform over the last few weeks. If you look at what we've got set up for the coming week, we've got 5 Affirm, we've got 5 Roblox, both sold with a little bit more premium, but we're mindful of our break-even price of $17.19 on Affirm and $25.28 on Roblox, and we're going to let those sit with our new hypothetical red lines and see where we go from there. Moving a little bit further down, the one thing that really kind of crushed us this week, unfortunately, was our good friend DraftKings. However, this one, we were able to scrape together, $1,760 of premium that we collected to offset the $39.40 loss. So it was only a net loss of $2,000, but anytime you're dropping $4,000 on shares, that's never a super fun week. But DraftKings was another fun one. Fun is definitely a creatively used word in that sentence, because it got down to 10.52 on that Thursday afternoon low that we saw. And those are always a little bit scary because you never know what's going to happen. We went into the week knowing that we didn't want to necessarily strangle DraftKings right off the bat. We wanted to wait and see, because if it fell further, that would be a good opportunity to strangle it. If it ran higher, then we wouldn't even need to worry about the strangle because we'd be happily making money off of the shares. But again, Monday morning, as we have seen with a lot of the other stocks, it didn't exactly cooperate. Dropped from 12.42 down to 11.4, and I think when it was at about 11.80 here, we said, okay, huge red candle. Let's jump in on some 11 strike puts. And we did so for about 20 cents in premium, which we opened a little bit too early because these things ended up getting pretty high in premium. But you got to trust the process. You put your trades out there, you let them go to work, and things will resolve themselves. So from these 11 strike puts, made $360. We sold 13.5 strike puts that we got out of very, very quickly after this initial dip. Because, if you have a covered call that's only trading for a couple cents on a Tuesday, no point in really keeping that thing on. It's only limiting just in case there's anything crazy that comes out. All it's really doing there is limiting your potential profits. So we got out of those, and then as DraftKings rebounded during the week, we said, okay, let's jump back in and collect a little bit more premium, and we were able to do that, grabbing about 13 more cents of premium. So between those 11 strike puts, the new 13 covered calls, that again is that $17.60 of profit, which helped mitigate the big share loss. So yeah, that sucks that we lost money on the shares. But again, when the market goes down 6.15%, and again, Last week was the single worst week in the market so far in the year for the S&P 500. We've seen so many different headlines about, okay, this is a record-breakingly bad start to a year for the S&P 500, but even in the midst of all that, last week was so bad that it was the worst week so far. So things like this are going to happen, and we accept that as part of our strategy, because when you combine the premium we collected with the share loss, it's only a $2,000 loss right there. And if you combine that with Affirm, Snow, Roblox, like we've already discussed, it nets out to a 745 loss. And, that's how you tread water when things like this happen, because if the market stays flat, like we're going to talk about for the coming week here, that's when you make your money. But I digress. That was what happened with DraftKings. And the one, I guess, silver lining with DraftKings is we've been talking about this one for such a long time, and I'm so confident this thing is finally going to get to a conclusion at some point. But we've been playing this thing for roughly, since the end of November of 2021. We started playing the stock at 36. It's dropped 68.28% on us, which is a catastrophic, stock market crash level drop. If we had just purchased shares, we would have lost $49,000, but we're only down 7.5K. And the best part is we've worked our break-even price from, the 36 that we started at, bit by bit by bit by bit by bit, down to 15.2 as of last Friday afternoon. And then this coming Friday, we should be able to get this down below 15, which I think is a fantastic milestone for us to have reached in such a short period of time, knocking about $20 of premium off the stock. And you might be saying, okay, premium was obviously a little bit higher back when DraftKings was trading at, the mid to high 20s. So HT, can we reasonably expect to continue this pace? And what I've done out here in column N is I've calculated the amount by which we've reduced our basis every single week. And on average, we've reduced it by 51%. And a lot of that, even if you just look at April onwards, the average of these right here is 42 cents. So slightly lower, but still, if we could take 42 cents off of our basis a week, 10 weeks from now, that basis is going to be 4 weeks lower. So 2.5 months, we could be looking at an 11 basis. And while 2.5 months from now, DraftKings may be down at 8 and we're still chasing it, the point is we're making progress. And 0, obviously, is the absolute lowest that a stock can go. So we're going to continue to drop this break-even price, continue to chase DraftKings down this dark hole, because I do believe it's a really good stock, especially at these levels. So I'm going to continue to invest. And what we did set up for next week, again, was the strangle, because it just had such a bad week last week. Normally I'd wait to leg into the strangle, but with how bad it was last week, we were able to get 40 cents off the 11 strike put and then 19 off the 12.5 that we have set up for next week. So if it bounces back up to 12.5, we'll grab $2,000 off the shares, combined with about $1,100 from the premium of the options we sold for $3,000 potential max gain. Just if DraftKings jumps back up a buck. And again, it started last week at 13.4, so 12.5 is not too far-fetched. We want to set realistic targets for ourselves when we're playing these back up. Yes, our break-even price is at 15.2, and our profits, at least this week, are capped at 12.5 with the covered calls we sold. But the odds that it jumps from 11.42 to 15.2 in a given week are very, very low. We want to play the high percentage trade, collect as much premium as we can get, and eventually these numbers are going to work themselves out. And I know those of you who have been following have heard me say that. I mean, probably since this thing was damn near 30, but I hope at this point we are getting to the point where, we've almost reached a proof of concept here with the HT wheel on DraftKings, mitigating just a total disaster as this thing's dropped 70% on us in about 6 months. But back to the recap from last week. Bed Bath & Beyond, that actually, netted out to about even though the stock dropped 36 cents. We had 35 cents of premium that we sold. What the hell? Bed Bath & Beyond, the premium's still at a really, really nice level. If you look at the chart, and we go BBBY right here for you, you're going to see if we go to the 180 day right here, Bed Bath & Beyond is actually at a really, really good level, historically speaking. Over the last 180 days, there was decent support at this 12 level, which, was deemed worthless as the market continued to drop over the past few months. But just continuing to play it in the 7-ish level is something I'm fine with. I would not care if these things got called away. And that's why for the coming week, I sold a 7-strike call for 38 cents a premium, meaning that no matter what, we're going to catch $380 of profit off this. And if it jumps 28 cents up back to the 7-strike, we'll get those called away for about $280. So, we could bag a $600 profit next week on Bed Bath & Beyond if it gets back up to 7, and we could take it off the list of our holdings. But I think right now the premium makes enough sense for it to stay in the game. CYN was one we talked about on TikTok when we made a YouTube short about it, so we had a little bit of attention surrounding that trade. But we sold that 2.5 strike put for $1.25 off the bat when we jumped into it. We closed at $1.15. It's showing 150 of profit last week, but that's just because it was up to $1.30 before. But again, selling something for $1.25, closing it out for $1.15 is $100 of profit. And why do we like this one so much? It's one of our IV reversion trades. We were alerted to it in our Discord server. You could probably see the little spike if we zoom in here to the 20-day. There you go. There's the big spike up to about two-ish. The spike's back here on 527, up over $2 a share. So what happens is, you see the big spike up past 2 off of good news. It was partnership news. And then if you go to the 180-day chart, there's somewhat of a trading. This is not the 180-day chart. What's going on right here? I don't know why the 180-day chart. There we go. It just wasn't loading. And there's somewhat of a base right around this level, the 125-ish level. So we said, okay, I think that's a good spot to sell a cash secured put. So we did it back when CYN was trading at about $2 a share. It fell all the way back down to 112 and then popped back up because, you might say it doesn't make any sense. This thing has dropped from 2 down to 112. And sometimes there's an equally inexplicable bounce from 112 up to 180. And then it settled back down at 135 for us to lock in that profit before end of day. But the idea here is that when we set ourselves up with 2.5 strike puts that sell for $1.25, our break-even price is 125, right where this red line is. So the idea is that it's kind of a race against time. No matter how crappy the stock may or may not be, this thing's at 2, it has to stay above 125 for the next 10 days. And those are odds that you really like. And if it runs up past 250, you hit max profit, and there's this big payout of like $1,200 that we would have loved to have. But, the market was down big time over this 3-week stretch. And even though CYN was also down big time from the point that we entered at about 2 a share to where it settled at 134, thanks to the option selling, thanks to the IV reversion opportunity, and thanks to the, alert that we received for this, we were able to set up a trade where even though CYN did kind of die and fall off a cliff and fall back down, we made money on it. And those are the types of trades that you should be leaning a little bit more heavily on in a questionable market. Those IV reversion trades, we like to talk about them so much because they're relatively disconnected from the overall market. Meaning that, look, this was the worst week ever for the S&P 500, and by worst week ever, I mean worst week in 2022. But despite that, CYN actually went up that last week. So those really aren't as dependent upon movement in the overall market as some of our other core holdings. So that's why we like to have it in there and mix it up a little bit. SPX, these are exclusively bullish put spreads. And you might say, okay, we talk about these 1 or 0 day SPX spreads. I honestly think they're a fantastic strategy depending on how much time and effort you have to devote to the market. But we started running some of these. And again, the S&P 500, which is roughly the same level divided by 10, of what SPX is at, but SPY started at 389 and it finished the week at 365. So if we sold, how many are right here? 5 different bullish put spreads. Yet despite that, and despite the catastrophic week, we only lost about $865. So let's talk about our approach here really quickly because I think this is something we're doing really, really well. If you look up here, our spreads profit year to date is about $6,000. We definitely haven't been using these as heavily until recently. But if you look at what we have been using, there's $135 of profit from spreads, 315, 1300, 690, and there's a loss of 1540. But again, the week before that, we made 1800. That nets out to a gain, and we've been making all this money, in a very, very turbulent market. So let's talk about the approach we have with these 0 or 1 day SPX spreads and how we decide to manage them. So right off the bat, we like to start with the smallest of the small positions. I like to think of 3, 5, and 7 as my position sizes for how I set this up. And there's a little bit of a martingale type approach where if you lose, you double down, you lose, you double down. And, that's a little bit of a fallacy in a place like Vegas if you're playing roulette because it's a series of independent events. However, in the stock market, the movement in the price of a stock or an index is not a series of independent events. The more red days you have in a row, the more likely you are to have a green day. However, when you're playing roulette in Vegas, the more reds that you hit in a row don't impact the odds that the next day or that the next roll is black. So we have a little bit of that martingale type system working to our advantage here. But let's talk through we started with. We like to start with the $5 wide SPX spreads. We like to sell them for about $1 premium, meaning that where our max profit is 1 on a $5 spread, the $5 is the width minus the $1 credit we receive means that there's a $4 max loss on these spreads. So $1 max gain, $4 max loss, meaning about a 25% return on the capital that we have at risk per trade, which individually is a fantastic number, but you'll find that that max loss number comes into play a little bit more often than you would like to have happen. But right off the bat, we sold 3850, 3845, and the general rule we want to follow with these is to never take max loss. If we had held on to this one, it would have been worth 5, and we would have lost another, $500, $600, $700 off this. So by closing at 3.4 and rolling lower and increasing our size, we saved ourselves a little bit of money up here. KP Vols in the Twitch chat, what's going on? Welcome to the stream. Then again, we followed that martingale approach, right? The first one was a loser, but what do we want to do? We want to roll down, we want to roll out, and we want to increase our position size. So we go from 3 of these to 5 of them. And while that does increase our potential amount that we have at risk, it also increases the potential gain, right? So while we lost $750 on the first one, if these hit max profit, we make $500 back. Yes, it doesn't get you all the profit back, but you have to take a step back and say, okay, what are the odds that within 2 days the S&P 500 goes from 3890 to 3720? And the odds are not very high. That does not happen very much at all. However, this is a fantastic example because it happened. And the second that this long leg was breached, meaning that the second it dropped below 3725, that's the second that we are put in that hypothetical max loss position. And that is the exact moment where we want to bail on these. So again, the number one rule that we talked about is avoid taking max loss. And this one was a little bit regretful too, which is why this is another great example of these SPX spreads, because if we didn't close this one out, it would have hit max profit. We would have gone from a $900 loss that we locked into a $500 gain, which is a $1,400 difference, which is enough to keep you up at night sometimes. However, that would not have been smart to hold on to these because, again, what's rule number 1? It's don't take max loss. So what we did, we rolled down, we rolled out, we increased position size. We increased position size from 5 to 7. We rolled the dates out from 614 to 615, and we lowered our strikes with our short leg going from 3730 to 3645, another 100 basis points down on SPX, which is a significant distance to for this thing to drop. And with last week being the worst week in the market for the S&P 500, we were really battling up against it. But again, we finally had this large position size, and I believe this was when the Fed spoke, and we were able to get out of these before the Fed talked for a $525 profit, and we said, okay, that's not too bad. So over these 3 positions, the S&P 500 was down a ridiculous amount on the week, and we lost about $1,100. Not the best thing in the world, but it could be worse. So what we did was once we hit the winner, we start the process over again. We started with 3 with 3650, relatively similar strikes. And again, it breached those strikes. So what did we do? We jumped out immediately. And you'll find that roughly 2.7, 2.8 is what you can close these things out for when it breaches that long leg, meaning when the index gets to what would be max loss territory for you. And we rolled the strikes down to 35.70 on the short leg. We rolled the strikes out from 616 to 617, and we increased our position size. And what you may notice here is that we went 357 the first round, and we went from 3 to 8 the second round. This was just more so in my belief that the S&P 500 was extremely overbought. You kind of have to pick and choose your spots to be aggressive, because if we were aggressive right off of the bat here earlier in the week, we would have gotten crushed on that if we had a few more contracts. But later in the week, you get a good idea of what the S&P 500 moves like when you trade it for a decent amount of time and get to the point where you know that even though we are in a volatile market right now, some numbers are kind of ridiculous if we reach those. And, that's not to preclude the chance of us running into a crash type situation where we do see a crazy number and then this hits, that 2.8 number again and we're down 2,000 more bucks. But if the market crashes, that's the great part about these spreads is their defined max loss. So our overall loss would have been probably like $3,000 or $4,000, which again isn't a great number. However, that would be our loss in the event of a crash. So we are protected on these. But again, at the end of the week, it finished above 35.70. So we got $800 of profit off that final set of SPX spreads. So 5 spreads on a week where the market was down terribly and these were all bullish, we netted out to an $865 loss. So you know what? Not too bad. And with the Redbox short call credit spreads that we had, we actually netted $1,000 on the number last week on these, which was fantastic. We could talk quickly about Redbox because we love to talk about our IV reversion alerts that we have in our Discord server, right? If I drag this tab over here, you will see our beautiful Discord server full of our premium channels. And what I love, one of my favorite features in our premium channels are the IV reversion alerts and the stock halt alerts, because we talk about trying to identify trades that are disconnected from the market. These are two of the main sources I look for in accomplishing that. So we saw Redbox pop up on here a lot, and I mean a decent amount of stocks do pop up on here. And for those of you who are listening right now, I did put a little work in this weekend. So I think by the back end of this week, the alerts we get in here will only be within 14 days till expiry on stocks that have options that are either at the money or out of the money and have at least one contract worth of volume. Because a lot of these, yes, the opportunity is there, but it's kind of annoying to get the alert and then go to your app and look at your broker and then find out that, oh no, there's no volume on this, or oh no, there's only in the money options, or oh no, the options expire in a month. So all of those kind of false results, in a sense, I'm hoping to eliminate and clean up the value of the data that comes through here. But I digress. We had a YouTube video recently that talked about how useful these IV reversion alerts can be from a bullish perspective, but they can be equally useful sometimes from a bearish perspective. And Redbox is a fantastic example of that. So if we type in RDBX, Redbox popped up on our IV reversion alert scanner because we had some really, really big spikes. You see the spikes in implied volatility throughout the 20-day period that we have shown here. And once we did a little bit of research on Redbox, what you'll find out is that they had a really interesting setup. They were being engaged in what's not called a takeover, but a take under. And it's called a take under because they were being acquired by CSSE for a value less than what the shares were trading at. So in that situation, common sense says, okay, they're about to be acquired for, say they're at 5 right now, and they're about to be acquired for $1 a share. This seems like an easy short. But as we know, when a bunch of people pile into the same stock with a big short interest, some really, really weird things can happen. And that's exactly what we saw with Redbox. It spiked all the way up to 18.2, but we took that example, or we took advantage of that to say, okay, this popped up on IV reversion alerts. Yes, the IV reversion typical trade that we outline is bullish, but if it does pop up on there, we know there's a lot of volatility, we know there's a lot of premium on those options, so you could use that to your advantage to make a bearish trade when we're convinced that something's going down, the way that we are about Redbox, right? So if you zoom out to like the 180 day, you'll see this thing was in the absolute gutter for the longest time before all this short interest came in. It squeezed, and this is nothing more than a squeeze. This thing's going to end up in a single digit in a few months from now, but the big question mark and why it's so dangerous to short the thing is we don't really know exactly when and exactly how long it'll take, which is why you should never naked short a position, which is why we used spreads. And again, we use those spreads. Let's see, where are we? Come on. We use those spreads to play it down. 13 and 18 strike expiring last Friday. We were able to get out of those a couple days early for $420 a profit. And the 10/17s we sold for July, we sold this for I think $1.10 a piece, and they spiked up as Redbox spiked up. So similarly with how we talked about scaling into trades like Roblox and Affirm, you should also scale into your short trades like this, because while a 10/17 call credit spread looked fantastic on Redbox, it kept flying up to like 16/17, and we said, okay, if we thought this thing was good to short at about 9, then you absolutely love it at 16 to short. And that's when we had that little extra capacity to add the 13/18. So it nets out to a really, really nice combined gain of $1,000 last week. And then moving down the list, we have Opendoor, which has just been sucking the life out of me. If we take a look at the trade breakout tab right here, we started this trade at 712. Opendoor is now at 483. We started this almost exactly a month ago. And since then, in that month, it's dropped 32%, which, as we all know, is a very tough thing to manage right there when a stock drops 32% on you. But as it stands right now, we got our break-even price from that initial price of 712 down to 510 as of the end of day last Friday, and we could continue to drop that down this Friday. So we'll just stick with that one. We've scaled in. Our initial contract size was 10. We've scaled into 20 and now 30 of these, and we actually were in 40 of them right here. These four for 617, and I need to update the date on this because this is now 624 to avoid confusion for those of you following along. But yeah, that last round that we had lost $710, but we lost only 710 on a slide from above 6 to below 5, which is quite the move. And volatility works both ways, so we hang in there, we lower the break-even price, and we wait for the bounce. That was something we executed very, very well with SoFi, which is a little bit further down the list, and we actually made a couple $100 off of SoFi. And we did so. And again, this was another one. We started playing a couple months ago when it was at 935. Now it's down to 570. It's down 40%. And if you're watching this and following along, you might say, oh my gosh, does every single stock you pick go down a ton? The answer, lately has felt like yes, but is no, because the only time we really have to manage a trade like this is when it goes down, right? If a stock goes up in a week, we close out for profit. We never worry about it again. It's really only the losers that we have to end up managing like this. And the great thing is we can very effectively manage them, as evidenced right here. We started at 935. Our break-even price as of last Friday afternoon is down to 571. And again, our initial contract size was only 10. So while we sized into what's currently 30 and what got as high as 40 contracts for Open Door, on SoFi, we're only up to 20. So we have capacity to scale even further in. But the idea here is our break-even price is 571. The stock's at 570. There's simply no need for us to scale in any further right now. We don't need to use that capital unless we're trying to fight off a loss. Don't use the capital unless you need to use the capital. Because if this thing pops back up to 6 this week, we've got a trade where the stock is down 35%, but we've made $560 from it, which is the value of the HT wheel. And something I cannot emphasize enough is that despite what is a disaster, quite frankly, if you were an owner of the stock at 935 and you woke up to see it at 6 where you're down 35%, with the strategies that we use and put it into the market, if SoFi is at 6 by the end of the week, we will have weathered a 35% drop to make $560, which is a 9.8% return despite that. And that is a huge difference in returns. And that is, those are the types of strategies we put into play during the bear market to help fight some of the volatility we've seen on a week-to-week basis. CLF is a steel company. I like the idea of having a commodity in the portfolio during these times of inflation. That thing got up as high as 30 where I didn't really want to touch it. And now that it got to 20, and I don't really remember exactly where it finished the week. I think it's in the 17-ish range, but one that I'm now happy to hold in the high teens. And we'll continue to play. As you see, we've got 16.5 strike put set up for next week. But that was last week. A lot of different things. You'll notice none of these trades individually are a huge home run. Yes, it's mission accomplished when on Roblox we take home, $900. On Affirm when we take home $455. But all these different strategies, right? Scaling into Affirm and Roblox, running the HT wheel, jumping into a covered strangle on DraftKings, long-term cash secured puts on Snowflake and Netflix, IV reversion with CYN and bearish IV reversion with Redbox. We've got our 0-day SPX spreads, and then we've got some additional trades where we're scaling in as well with Open Door and SoFi. All of these different things, even though they're all option selling strategies, provide a different level of diversity to our portfolio, and these things all work together to help us find success on a week-to-week basis. And while you might say, you lost $1,900 last week, I still define that as success because the market was down 6.15%, and relative to our account size, that's only a 1.4% loss. So we accomplished our overall goal. All of these strategies that we just outlined during the recap working together hand in hand to help us outperform the S&P 500 by 4.76%. And while we had some seriously big missteps off the bat by losing, about 40K in the first 3 weeks of 2022, we've adjusted, we've adapted, and since then we are profitable despite the fact that the S&P 500 has gone from 437 to 365. So seeing that roughly 80 point, 70 point drop in the S&P 500 while we have treaded water and actually slightly made a couple $1,000 is some seriously big proof of concept for us. And you might say, maybe this is benefiting off of, the bearish movement in the market. And I can assure you that's not the case. We would always prefer that the market go up. But the advantage with our strategy is that you could still survive in a bearish type market like this. Because if you look at our 2021 year-to-date summary, it was pretty smooth sailing. The S&P 500 was green 9 out of 12 months of the year. And we didn't lose money a single month of the year, which was fantastic. So we were kind of due, and look, we really, really crushed it. It wasn't like we were just in line with the outperformance. We came in with a profit of, I think, 109%, as compared to 27% for the S&P 500, and that's illustrated by our performance since inception right here. Where we're just a hair under, and I think this actually needs to be updated right here. Give me 1 second. Down right there we go. Delete that out. Demonstrated by our performance since inception, which is plotted here. There we go. We are back at about 100% return since July of 2020. And you might say, HT, July of 2020, that's excluding the COVID crash. So you're just saying you're up money excluding the COVID crash. And the truth is that this is actually a little bit conservative. If we look at 2020, we actually ended up making 163% during 2020. A lot of that was on the front end of the year before I started publicly tracking everything on the spreadsheet. It's kind of why I started the Discord and why things ended up getting big in the first place. But in the interest of being as conservative as possible and presenting these, showing a 163% gain right off the bat that wasn't publicly tracked, doesn't do either of us a whole lot of good. We try to stay away from the clickbait. We don't want to be deceiving, so we just ignore that part of it. So this is as objective of a start point as we can get. We saw us continue to shoot up. We saw the big mistake we made with Hyliion, which again was another very important lesson learned to take us negative. But despite, the ups, the downs, the two big drops that we've had where we made a big issue with position sizing and an issue with the stock we picked, despite all of the big mistakes we've made, we were outperforming NASDAQ by 84%, outperforming the S&P 500 by 72%, and have a 100% return since we started publicly tracking almost 2 years ago. And, these types of market conditions are where we like to think that we make our money. If we could hang in there, battle back, and at the very least tread water. Obviously, I'd like to outperform, but when the market is smooth sailing, we know what it looks like. And we know what we can count on when things are smooth sailing. We just have to be able to tread water when it's not. And so far, I'd say we have. And I think with what we have set up in the future, we can continue to do that. So here's what we've got set up for the coming week, what we like to consider our quote-unquote base profit for the coming week, meaning if things don't move at all, the market doesn't go up, the market doesn't go down, there's only 4 days in the coming week. Yes, we could say, if the market goes up and DraftKings goes to, 13 and everything explodes, we can make $8,000. That's not really an objectively good way to look at it. Because I think the market is just as likely to go up as it is to go down. So I think the most objective way to evaluate what we're currently holding is to say, okay, what's it going to look like if the market finishes flat? And this is exactly the answer to that. So we will have a base profit of $4,232, and despite a trepidatious June in the S&P 500 where it's down 11.9%, we have that 4232 pulled in. We can actually make money in June despite a double-digit percentage loss in the S&P 500. And one thing that I want to point out is how much we've adapted to these current market conditions. Because what do you notice the last 2 times we had a big red number on a monthly basis? The answer was in January, where we made a huge mistake. We lost 38K. But in April as well, the market dropped 9%, and we lost 29K. So I really did want to objectively evaluate what we were holding and saying, okay, with what's going on in the market, with the approach the Fed is taking, with what inflation looks like, we absolutely could see another 9% drop over the course of a month. How can we adjust the strategy to, survive that type of a drop? Because we could bounce no problem when we're have these big position sizes. The issue is the big upfront drops. So we adjusted in May, and as you can see, since May, we've had a really, really nice return from the bottom of May, right? If you take a look at May 8th onwards, we've made about $14,000, and May onwards in the market has dropped about 10%. So I think that is about as clear as we can make this, make the case for what we're doing in the coming week. And I think we've already talked about pretty much all these, starting with the 5 Affirm 18.5 strike puts. We know that we got a 1.31 credit on that, giving us a break-even price of $17.19. So as long as Affirm stays above $17.19, we don't need to touch it, because at max profit, if this thing expires worthless, we're getting $655. Similar story with Roblox, 26.5 strike put. Those things were going for $1.22 at close on Friday. 25.28 break-even price when the stock's trading at $26.87. So again, as long as it stays above $25.28, I feel no need to even touch that stock. So as long as, Roblox doesn't, or as long as it does better than a 4% drop, we're making money there. DraftKings is probably the one we're a little bit more aggressively in on, and I want to get aggressive, especially because you see big bounces in the market after big red weeks like this. It just happens, right? Even when things grind down to the bottom, it's never a straight line to the bottom. You'll notice that the overall trend in the S&P 500 is on this big downtrend. But along the way, after these big drops, we see little rebounds. Big drop, big rebound, huge slide, a 6% rebound of the market, which is enormous. And we're on another one of these big slides. And I think if we're following this channel down, well, we're due for a slide. So we're due for a rebound. So I wanted to put myself in position to collect profits based upon that potential rebound. So that's why I got a little bit more aggressive on DraftKings. You'll notice 88% of our money fully cash secured is in the market right now. Typically, when the market is down like this, I want that number to be a little bit higher. But I think from a macro perspective, the approach I'm taking is at least until September or October-ish, things are going to continue to be bearish. So instead of getting aggressive here and trying to catch like an 11K week and say, oh, we're crushing it in June, what I really want to avoid is things continuing to move south. And instead of saying, oh, going from someone who's saying, oh, we could have made $144 in June to looking at a 10K loss again. So avoiding the losses right now, I think is more important than chasing the big gains. Because as long as we can stay relatively flat, I think we're going to do pretty well in the coming months with the current market conditions. But we've talked about pretty much everything we've got. Affirm, Roblox, DraftKings, Fubo. It was trading at 275. We had 40 of the 3-strike puts last week, and since 275 is halfway between 2.5 and 3, I couldn't make my mind up on which I wanted to sell, so I cut the position in half. Sold half as 3-strike puts, sold the other half as 2-strike puts. I think that's a pretty good trade-off from a risk-reward perspective. So we're going to ride with that. Bed Bath & Beyond, again, I said I wouldn't mind getting these things called away, so leaving about 28 cents of upside on 1,000 shares leaves upside for $280 on the shares while getting $380 of money no matter what from those covered calls that we sold. Open Door, the 5-strike puts that were trading for 37 when we jumped into those. We could potentially get some pretty nice profit right here if this thing jumps back up above 5. We're going to be bagging over $1,000 of profit on Open Door, but again, that break-even price is $463 for the week, so we draw that red line on the chart. If it stays above $463, fantastic, we're bagging some cash. But if not, we potentially scale in a little bit more. SoFi is in a similar position where the break-even price for the week is $563. Well, remember the break-even price for the overall trade is $571, so those are kind of one and the same. And if it stays above $563, really no reason for me to touch it. But if it does drop below that, that's another name that I think is prime for scaling further in on. Cleveland Cliffs, you'll notice this is already about 11% of my account fully cash secured. I don't think I want to increase the position there. Instead, I'm hoping that these expire worthless for $440 of cash. Then I can kind of start this one over, so to speak, scaling in similarly to how we're handling Affirm and Roblox. And that's kind of about it for what we got into the coming week. A much lighter stack, right? We point this out a lot, like last week. And then one thing I did start doing is highlighting the new trades purple just so we could point that out. Because going into the week, our base profit is a 3% return. It's $4,200. Fantastic. I love where we're sitting with that. However, if we do nothing, that's a good place to be. However, it's pretty tough to do nothing in these markets, and the volatility that we've seen, whether it's between our IV reversion trades, something from stock market halt alerts that we see in our Discord server, or just other general movements in the market that we see, that is where we have seen a lot of opportunity lately. So again, last week, even though the market was down 6.15%, if you sum up the new trades that we made, they equal $2,000 of profit. And that's off a really bad week. So without those new trades, we would have looked at a 4K loss. These new trades are really helping. Now, the week before that was horrible. Another 5% drop in the market, and our new trades lost about $1,400. But again, that's netted out with this 2K right here. We go another week back, another red week in the market, but the patience that we had keeping some money on the sidelines, waiting for that bad day in the market to scale into some trades, add some new trades, it bagged us $1,300 of profit. Again, the week before that, $561 of profit, and we didn't have as many new trades during this week, or I guess we blew up on a couple SPX spreads. But the non-spread new trades bagged about $1,000, and I think that's about as far back as I went. You lost 80 that week, yeah. But you get the idea, right? With this volatility in the market, and again, this stretch that we just scrolled up on to look over, the market was very red over that stretch. Yet our new trades net out to make us, I think, a few $1,000 in profit. So while it's great to have the game plan that we have going into the week, and we have game plans associated with scaling into these individual positions as far as the current size and the context of what we're holding for the week and the context of the overall trades that we're in for each of those individual tickers, there's so much opportunity on a day-to-day basis. So that's why I'm always trying to be plugged into the Discord server, sharing my ideas, and more importantly, or just as importantly, getting ideas from you guys in the group, because I've gotten a lot of good ones. If you look at ADN was one that was on our IV reversion alerts. Honestly, I wasn't really paying attention. I was at work. I think Carter called that one out for us, and it bagged us $350 of profit. This is a great example of a good IV reversion trade that's disconnected from the overall market, because this thing jumped up and we sold 2.5 strike. What did we sell? Yeah, 2.5 strike puts. We sold those for 40 cents a piece, meaning, right, if you look at this 20-day chart, 2.5 minus 40 cents a premium means as long as after this big green spike it stays above 210, which again is that 2.5 strike minus the 40 cents a premium we received. As long as it stayed above that line, we were going to make money. As long as it stayed above this line, we were hitting our max profit. And as it continued to climb higher, we were actually able to exit the trade a day early for $350 of profit. And there's no profit quite like realized profit. So that was a fantastic one to help kind of pad some of the losses from the week. But again, opportunities like that, which is why it's important to keep your eye on the Discord server for ideas that people are throwing both in the channels and the option alert bots that we have set up. And if you are a premium member of our Discord server and you're wondering how to get alerted to these, because you'll notice you get tagged and the alerts come to your phone, because these are, quite frankly, time-sensitive trades, these IV ones. Pop into the premium announcements. Go down here, hit the diamond if you want to get alerts for the IV reversion. Hit the stop sign if you want to get alerts for the stock halt alerts. I think both have been fantastically useful for us. And if you're not part of our Discord server, it's free to join. We've got our main chat room right here, and the goal is, as always, to just teach option selling strategies for free. We've got beginner questions right here. All the videos that we've made explaining the strategies and some of the things along the way you can find here and watch them for free, because at the end of the day, the reason we created this community and came together is because I got really, really frustrated by seeing people give terrible advice on the internet, claiming that you're going to turn $1,000 into $100,000, and seeing just people who were genuinely interested in investing getting steered down a terrible path. So the education is always going to be free, but if you want to take your trading to the next level, getting things like alerts to different conditions in the market via the IV reversion and the stock halt alert bot, and the trades we make as we make them in real time, alerted, hourglass-trader.com. You could sign up for HD Premium, and that is the end of my self promo. We've got a question from Matthew Ellis saying, what Leaps options are you buying and selling? And now I am pretty aggressively anti-option buying. I do think there is a place for Leaps. However, I really don't think that place is right now. I think ideally, the ideal market conditions for Leaps. Let me pull something up here. We're going to make something really nice. Where's the snip? The snip tool. I guess we can just snip some random part of the screen here. Boom. So the point I'm trying to make here, if I scroll down into this white space, right now the market is basically looking like this. This right here is not where you want to sell Leaps, because Leaps are a type of option buying. And when the market looks like this, implied volatility is very, very high. And when implied volatility is high, option premium is similarly high, right? If you look over the last 20 days, implied volatility is about as high as it has been on the S&P 500, which is saying a lot. Go to the last 180 days. Actually, let's go to the last year so we get our indicators in here. Indicator, not working. Okay, let's go to the last 180 days. But you'll see on a 180-day basis, volatility is very, very high. If you're going to be trying to purchase Leaps, I would recommend waiting for it to get back down to the 0.2-ish area, because that, the difference between 0.2 and 0.33 on this implied volatility metric are very, very different. So I guess the ideal, chart shape, let me click an X on this because we don't want the chart to look like that. The chart that we want if we're thinking about buying Leaps is, yes, we're going to have this big drop down, but we want a little bit of a rebound, and it'll probably start to flatten out a little bit. When it flattens out, that is when you should strike on Leaps. Let me change the color of this. This right here is what you want to look for. Flat movement in the market, because that's going to drop implied volatility down and give you a better deal on those Leaps. In general, I still feel like option buying is a tricky value proposition just for the sole fact that, you're kind of racing against time and the option premium that you're purchasing. That's why we only sell options. But, that's not to say there isn't a place for that in investing, but this is the place for it. Not this hypothetical thing I've drawn and then out to the right here. This is not the setup you want to purchase leaps off of. What you want is to see something a little bit maybe more like this, right? Even off this big slide that we had back in January, a little bit of chop. You see this big slide that we had back in February and it bounced, but again, it chopped around for a little bit before ripping back upwards. That's typically what you'll see. The V-shaped recovery is a little bit of a meme in the investing world, and there is some truth to it, but in those types of conditions, you wouldn't really even benefit that much from the leaps. We've got a question from Ashish in the YouTube chat saying, what do you think about TLT and TMF in the upcoming future? A bond question, huh? TLT, we've got the 20-year yields. And honestly, these are tough for me because, following the bond market and typically the casual relationship between bonds and stocks is that rates on bonds go up as they get more desirable. And they get more desirable when people don't want stocks and they want somewhere to throw their money into. However, as you can see over the past 180 days, TLT has not performed very well at all. If we go back to the 3-year, you can maybe get a little bit better context. For example, the COVID crash was right around here, and it dropped down even further. Saw a rebound, generally trading with the market. But honestly, I don't follow bonds closely enough to give an educated opinion on that. I think there's a lot. I'll be the first to tell you. There's a lot I do know about the market and a lot that I do know about option selling, but I'm not going to try to talk out of my ass when we're in territory that I'm not quite as familiar with. TLT, bonds, that entire environment is somewhere where I'm not quite an expert. I don't personally trade it. I don't pay attention to it. So I think me telling you anything on that would, be misleading at best. So I can avoid. I'm going to elect to avoid that topic. But I think that's what we've got for the coming week. We're at about the hour mark, and unfortunately, I have some non-stock market work I have to get done. But this is what we've got, right? These are the strategies. We've talked a little bit about how we've managed some of the current positions we're in, how we've managed some of the waves in the market, right? To get to the point where potentially this week we could turn green in June despite a massively red and as red of a month as we've seen in the S&P 500, and we're barely even halfway through the month. So scaling into different things, using those IV reversion trades and those stock halt alert trades, those are going to help you get a little bit more disconnected from the market so that if the market keeps dropping, you have a different way that you can make profit. Leveraging these 0-day SPX spreads to take advantage of intraday volatility, another great place to find some money. We've been profitable on that this year. But a lot of different avenues outside of the typical wheel. Because honestly, if you look at our profits from the wheel, we lost $2,000 last week, 2.3 the week before that, 1,200 the week before that, made 10,000, the week before that. So it's not all bad. But what's really been helping us is the diversity of positions we've had, right? The spread profit we had at the back end of May and the beginning of June pushed us to a profit despite a bad result from the wheel. And then we had another bad result from the wheel that was cushioned a bit by some of our spreads. Another bad result from the wheel where we made about $100 back off the spreads. No spreads right now headed into the week. I want to wait and see what SPX does off the bat. We could look at ES, the S&P 500 minis futures, and those are up about 1.4%. So I'm expecting good things tomorrow in the market. Fingers crossed. I think the futures have definitely given us a head fake a few times. But with the double-digit percent loss on the S&P 500 combined with the short week, I think it's time for at least some temporary relief, and we're positioned here to catch it. But that's about all we've got for this week. This is what we've got set up. If you're not in our Discord server, come join it. There's a link to do so at hourglass-trader.com, or you can also sign up for HD Premium, free 7-day trial with zero financial commitment, so you can decide if it's right for you. And again, it's not right for everyone. I'll be the first to tell you that, but I think it is pretty good value for what we provide, less than $1 a day for every single trade we make, all the alerts, and just some general info about the market to make you a more informed investor, because a more informed investor is a more effective investor. But for those of you who have tuned in tonight off our brief hiatus from streaming, thanks for joining us. This has been the Hourglass Trader, where as time passes, we make money, and we will see you guys. I think I should be able to stream again next weekend. We'll see you guys next week. Hopefully with more money in our account than we have right now. Thank you, guys.